Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're plunging into a critical 24-hour market forecast. We're focusing on key currency pairs, specifically from June 30th to July 1st, 2025, EST. And our source for this, it's a pretty comprehensive Forex analyst intelligence briefing. Okay, so right off the bat, the prevailing market narrative, the one everyone's kind of buzzing about, is this pronounced US dollar weakness, USD weakness. The big question we're tackling is, what's really driving this, this weakness, and how's it poised to ripple through the major currencies in, say, the next 24 hours? We're seeing, well, it looks like a perfect storm brewing for the dollar. You've got a Federal Reserve that's sounding incredibly cautious, lingering global trade disputes, and those massive bets against the dollar from the big institutional players. Really significant.
Yeah, and to really understand the immediate future, we need to zero in on some high-impact data releases. These could either, amplify these trends or maybe challenge them. We're looking at Germany's preliminary CPI, that's the consumer price index, right? Key measure of inflation. Then there's China's NBS manufacturing PMI and the US Chicago PMI. So this deep dive will unravel the multi-layered dynamics influencing 5 key currency pairs, give you the full picture.
Right. We want to deliver those aha moments so you don't just hear the data, but you truly understand what it means. It's about quickly grasping the essential insight from, well, a vast amount of financial information, leaving you well-informed without feeling overwhelmed. Okay, let's unpack this. So let's kick off with our Global Macro and News Flow Digest. This section gives us that crucial bird's-eye view of the market, which right now is absolutely defined by a big policy divergence between central banks and, yeah, you guessed it, a lot of geopolitical uncertainty.
Mm-hmm. What's truly fascinating here is the stark contrast in the economic outlooks. For the U.S., the consensus really points to a slowing economy. I mean, the final reading for Q1 2025 GDP actually contracted by 0.5%.
Wow, 0.5% contraction.
Yeah. And this slowdown, it's being exacerbated by this elevated policy uncertainty, especially around the U.S. tariffs. They're creating a tricky situation. They fuel inflation while simultaneously, dampening growth. And Federal Reserve officials, they've sounded distinctly dovish. Markets are pricing in at least 50 basis points of rate cuts in the second half of the year.
Okay, 50 basis points, so 0.5% cut expected.
Exactly. And Governor Barr's recent commentary reinforces this cautious, data-dependent stance. It suggests the central bank might hold rates for some time before acting, which has, directly contributed to a weaker USD as those rate cut expectations solidify.
So the Fed is reacting to a shrinking economy. Does that mean those rate cuts are pretty much locked in? Or is there any wiggle room if the data shifts?
Well, the market is certainly pricing them in aggressively, yeah. But Governor Barr's data-dependent stance, it does leave a door open. I mean, sudden positive surprise in inflation or growth could theoretically shift their timeline, but right now the momentum is firmly towards cuts. Now, moving to the Eurozone, the European Central Bank, the ECB, they've actually already started a rate-cutting cycle. They brought their main refinancing rate down to 2.15%.
Okay.
However, recent statements from President Lagarde and board member Knott, they suggest a potential pause might be coming. They want to assess the impact of those U.S. tariffs and the incoming inflation data. So the upcoming German preliminary CPI is a critical data point for the euro. Consensus expects around 2.2% year over year,
right,
which indicates, persistent but maybe moderating inflation. This is set against a backdrop of weak German retail sales, though. They fell 1.6% month over month in May, which points to fragile consumer demand in the Eurozone's biggest economy.
So the ECB cut, but might pause now while the Fed is about to cut. That's a significant divergence right there, isn't it?
Absolutely. And that leads us straight to the Bank of Japan, the BOJ, which stands in stark contrast to both the Fed and the ECB. Board member Naoki Tamura's recent statements, they signal a growing consensus that inflation is actually running stronger than expected in Japan.
Stronger.
Yeah, which could necessitate, decisive policy action. What's more, the BOJ is actively considering a reduction in its bond buying program. JGB tapering, they call it.
Tapering, yeah.
This is basically them slowly pulling back from their massive stimulus efforts. It's a clear move toward policy normalization, away from its ultra-loose stance. And that provides a strong fundamental tailwind for the Japanese yen. Finally, on China and global trade, the upcoming China NBS manufacturing PMI, it's a key barometer for global risk sentiment. Consensus forecast is 49.7, which, while it's an improvement, is still in contractionary territory.
So shrinking, not growing.
Exactly. The manufacturing sector is still shrinking. It signals ongoing struggles for the world's second largest economy. And that has direct implications for commodity currencies like the Aussie and New Zealand dollars, given their strong trade links with China. The primary market concern right now, it remains the potential for escalating trade wars. That 90-day U.S. tariff pause is set to expire in early July. Keeps everyone on edge.
Okay, so the global picture is weakening U.S. economy, a cautious ECB, and a BOJ that's finally getting serious about tightening. That sets the stage for some pretty interesting currency moves. Let's dig into the pulse of the market now. Look at where the big money is actually positioning itself.
Yeah, that's a critical point because when we talk currency flows, a clear divergence in central bank policy rates, that's truly a primary driver. If you look at the overnight interest rates, you see this divergence clearly. U.S. Fed funds rate, 4.50%, ECB's main refi rate. 2.15%, Bank of Japan, 0.50%, Bank of England, 4.25%, and the RBNZ official cash rate in New Zealand, 3.25%.
Big differences.
Huge differences. They create significant incentives for capital flows, right? Now, here's a massive insight. The Commitment of Traders report, the COT report. Think of it as a window into what the biggest, most sophisticated players are actually doing with their money. As of June 24th, 2025, it reveals a really stark positioning landscape among these institutional traders, often called large speculators or, smart money. For the US dollar, net short positions by these large specs have surged to a 5-year high. We're talking $21 billion short.
21 billion.
Yeah. It's a powerful signal. Strong institutional consensus for further USD weakness. The euro shows growing bullish conviction. Net long exposure increased significantly. They're betting on the euro going up. The British pound, still firmly positive in net long exposure. Continued institutional support there. For the Japanese yen, net long exposure is effectively flat. Suggests the large traders are kind of in a holding pattern, waiting for clearer signals from the BOJ. But perhaps the most fascinating here is the New Zealand dollar, the Kiwi. In a significant shift, institutional positioning flipped to net long. First time since October of last year. Reached an 11-month high.
An 11-month high, just flipped long.
Yeah, that's a powerful signal of a potential trend change for the Kiwi as the smart money moves in.
That $21 billion short position on the US dollar is truly staggering. Does that kind of extreme positioning by smart money almost like guarantee continued dollar weakness? Or is there a point where it could become a crowded trade and snap back?
Well, it's certainly a strong indicator, but yeah, no guarantee. The sheer size of that bet suggests really high conviction. However, like any trade, if it gets too crowded, there's always a risk of a sudden reversal. A short squeeze, right?
Right.
Where those betting against the dollar are forced to buy it back quickly. But for now, the signal is clear. Institutions are bearish USD. And while we don't have direct granular data for daily FX futures volume right this second, we can infer from the COT report that new money is indeed flowing into bullish euro positions and bearish US dollar positions. It validates the strength of these trends.
Okay, so to make all of this digestible, we used a proprietary model. It helped us select 5 key pairs for this deep dive. It weighted factors like significant volatility, high liquidity, those anomalous sentiment spikes you mentioned, and proximity to high-impact news catalysts. This filtering process, it really cuts through the noise to give you the most relevant action.
And based on that rigorous screening, we've zeroed in on these 5 pairs. USD was selected because, well, it's the world's most liquid pair. It's right at the epicenter of the Fed's dovish pivot versus the ECB's caution. It'll be directly impacted by the German CPI and U.S. Chicago PMI data. And that extreme divergence between institutional and retail sentiment makes it really compelling.
Okay.
GBP-USD, cable, exhibits a strong, clean, technical uptrend, high volatility. It's sensitive to US-China-EU trade talks, plus upcoming UK Q1 GDP data. USD JPY serves as a pure proxy for those diverging monetary policies, right?
Yeah.
Dovish Fed versus hawkish BOJ. And it's highly correlated with U.S. Treasury yields.
That makes sense.
EUR JPY is a key risk barometer. It's seen a powerful uptrend, but looks like it's now at a precarious technical juncture. Appears overextended, vulnerable to a BOJ policy shift. And finally, NZD-USD, the Kiwi. Selected specifically because of that anomalous sentiment signal we just discussed, large specs flipping long after nearly a year, plus its high sensitivity to the China NBS manufacturing PMI, makes it a good proxy for a bearish USD view.
So we've got the overall market themes, the key pairs selected. Now, what does this all mean for each of these pairs specifically? Let's dive into the multi-layered analysis technicals, fundamentals, short-term momentum sentiment, AI simulations. So Expert, let's start with USD.
All right, let's break down USD. Technically, we're looking at a clear, strong, bullish trend, daily and 4-hour time frames. It recently broke to a new multi-year high above 1.1700. Price is consistently above its major moving averages, all trending higher, acting as dynamic support.
Okay, strong trend.
Yeah. Momentum indicators like the RSI, the Relative Strength Index, they show it's bullish but nearing overbought territory. Suggests it might be due for a pause, maybe consolidation. The MACD, another momentum indicator well above its signal line, positive, confirms strong upward momentum. Bollinger Bands, which show volatility there wide and the price is walking the upper band. Classic sign of a powerful trend. Key support is around 1.1700. Next resistance looks like 1.1800. Fundamentally, everything really supports further upside for USD, mainly due to that narrowing interest rate differential, right? Fed cuts, ECB likely
But
pause.
the divergence.
Exactly. The upcoming German preliminary CPI, if it comes in around its 2.2% year-over-year consensus, that would reinforce the ECB's need to stay on hold. Conversely, the U.S. Chicago PMI, with a consensus of 42.7, that's deeply contractionary. It would just amplify the U.S. slowdown narrative, likely accelerating USD selling. From a short-term momentum view, USD's posted a significant gain over the last 30 days. Continued strength in the 7-day performance, too. Our analysis shows this move is statistically quite stretched, meaning it's gone up a lot, very quickly, often hints at a potential pause or pullback before the trend maybe continues. Sentiment. Across multiple layers, it's aligned for strength. The VIX, the market's fear gauge, has eased. That signals reduced market fear, typically negative for the safe haven USD.
Less fear, bad for the dollar.
Yep. The U.S. dollar index, the DXY, measures the dollar against a basket of currencies. It's weak. Confirms broad USD bearishness. Institutionally, the COAT report shows large specs are significantly net long EUR, and they hold that 5-year high in net short USD positions, massive positions. But in stark contrast, retail sentiment is overwhelmingly bearish. Nearly 90% of accounts holding short positions on USD.
90% short among retail. Wow.
It's extreme, and it serves as a powerful contrarian bullish signal. Suggests a large pool of potential buyers could fuel the next rally if those shorts are forced to cover their positions. And looking at AI simulation and order flow, probabilistic models show a high likelihood for USD finishing higher in the next 24 hours. Monte Carlo simulations, a way to model possible outcomes, indicate the most probable path is a test of the 1.1740 to 1.1760 area. Institutional order flow is clearly bullish. I mean, those massive net short USD and net long EUR futures positions, they're the footprints of the large players.
And see where they're stepping.
Exactly. Price action confirms it. Sharp upward moves, shallow pullbacks suggest large players are absorbing selling pressure, buying on dips. The 1.1680 to 1.1700 zone, that was former resistance. It's likely a key area of institutional bids now. Support.
Okay, got it. Next up, let's talk about GBP USD. Cable. Expert, what's the technical picture saying here?
Technically, GBP USD shows a strong, clean bullish trend. Recently broke above its February 2021 high, trading near multi-year peaks. All major moving averages are trending higher, providing dynamic support. The RSI indicates strong bullish momentum, but importantly, still has room to run before being extremely overbought. The MACD is giving a clear buy signal, confirming that momentum.
So momentum looks good.
Looks good. Price is in the upper half of the Bollinger Bands. The 20-period simple moving average is acting as support. Wide bands indicate trend continuation is likely. Key support is at 1.3780. Targets. Look towards the 2022 high at 1.3749 and then maybe the October 2021 high at 1.3835. Fundamentally, GBPUSD is really dominated by that broader USD weakness theme. The interest rate differential between the Bank of England at 4.25% and the Fed at 4.50% is expected to narrow as the Fed cuts rates. That provides a tailwind for sterling. Upcoming final UK Q1 GDP forecast at 0.7% quarter over quarter, that would be supportive too. But the primary driver remains that overarching theme, slowing U.S. economy, dovish Fed. In terms of short-term momentum, GBP USD is in a clear momentum phase. You can see it in its steady climb and that recent break to multi-year highs. Its recent performance shows an acceleration of this trend. It's not really a market for fading or getting against right now. Our analysis confirms statistically significant strength, though it also suggests, like the euro, potential for some consolidation before the next upward push. Sentiment. strongly aligned for further GBP USD gains. The weak US dollar index and easing VIX create that favorable risk-on environment weighing on the USD.
Risk on helps GBP USD.
Generally, yes. Institutionally, the COT report shows large speculators maintain a healthy net long position in GBP futures. This is reinforced by forecasts from major institutions like Morgan Stanley, who are projecting a rise to 1.45.
Yeah, 4.5. That's quite a target.
It is. And retail sentiment. Powerfully bullish as a contrarian indicator. Over 80% of retail accounts position short on the pair, provides a large base of potential buy stops if it keeps rising. For AI simulation and order flow, Monte Carlo simulations project around a 65% probability of GBP/USD closing higher in the next 24 hours. The 1.3750 resistance area is identified as the most likely target zone. Institutional order flow is firmly bullish. Strong advances, orderly pullbacks, it indicates large players are in control and accumulating on dips.
All right, let's shift gears now to USD JPY. This pair, as you said, it's almost a pure battleground for these opposing central bank philosophies. Expert, what's the story here?
Yeah, it really is. The technical picture for USD JPY is turning increasingly bearish. We saw that sharp rejection after the pair failed to hold above 145.00, and now it's testing a critical long-term bullish trend line.
Testing support.
Critical support. Price is trading below its key moving averages, which are now acting as resistance on bounces. The RSI has fallen below 50, indicating a shift towards neutral or even bearish momentum. The MACD generated a clear sell signal, confirms loss of upward momentum. Bollinger Bands have broken below the middle band, now testing the lower band, shows building bearish pressure. The key is that test of the multi-month ascending trend line, currently around 143.50, 143.75.
Okay.
A decisive break below that opens the path down towards 142.50, maybe even 140.00 longer term. Resistance is firm back up at 145.00. The fundamental driver for USD JPY, it's that stark and widening monetary policy divergence, US versus Japan. The Fed's signaling rate cuts puts downward pressure on US Treasury yields and the USD. Conversely, the BOJ is becoming more hawkish, openly discussing decisive action, JGB tapering amid stronger than expected inflation.
Total opposites.
Total opposites. This dynamic is fundamentally bearish for USD JPY. Any weak U.S. data, like that Chicago PMI coming up, will likely just accelerate the pair's decline. Short-term momentum for USD JPY has shifted dramatically. While the 30-day view might still show some residual gains from before, the 7-day performance is negative. The pair's fallen over 1%.
Okay, turning negative short-term.
Yeah. It indicates a transition from a momentum phase to potentially a reversal phase. Our analysis shows the prior uptrend is breaking down. Broad market sentiment is bearish for the pair, too. A weaker DXY and increased risk appetite reduce that safe haven demand for the USD. Institutional sentiment from the COT report is, interestingly, neutral right now. Suggests large players are maybe waiting for that technical break before committing heavily to the short side.
Waiting for confirmation.
Seems like it. However, institutional forecasts, like from JP Morgan, have been revised to reflect a stronger JPY. They anticipate a move toward 140.000 or even lower. Retail sentiment is mixed, about 60% long. Doesn't provide a strong contrarian signal yet, but could shift quickly if that key trendline support breaks. In terms of AI simulation and order flow, probabilistic models show a growing likelihood of a downside break. Monte Carlo simulations indicate roughly a 60% chance of the pair closing lower over the next 24 hours, with a significant probability of testing that 142.50 support zone. And while the COT data is neutral, the price action itself shows distribution. That failure up at 145.00, the sharp decline, it suggests large players were selling into the rally and are now maybe pressing the short side.
Now let's turn our attention to EUR JPY. This one seems like a real tug of war, like you said, given the different central bank narratives. What are you seeing here, expert?
You're right, it's a clash of two opposing forces. Technically, this pair has been a powerful long-term bullish trend. Higher highs, higher lows, trading well above major moving averages.
Strong uptrend overall.
Very strong. However, recent price action shows signs of exhaustion as it approaches that major psychological resistance level around 170.00. The RSI is in overbought territory. That's a strong warning sign the trend is extended, maybe vulnerable. The MACD shows waning momentum. A bearish crossover could be imminent. Price has been riding the upper Bollinger Band, but close below the middle band would be a significant bearish signal. The pair is approaching a major supply zone, 169.70, 170.00. A failure here could lead to a significant correction. Support. near 168.70, with more significant support around 168.00. The fundamental picture for EUR-JPY. Yeah, it's that clash. Strong euro due to the ECB's relatively hawkish pause versus a strengthening JPY from the BOJ's hawkish pivot.
So pulling in opposite directions.
Exactly. Creates a highly uncertain environment. The pair's direction will likely be determined by which central bank's narrative dominates the market's focus. A hotter-than-expected German CPI could give the euro a temporary boost, sure, but any follow-through on hawkish rhetoric from the BOJ poses a major downside risk. The pair has shown strong positive momentum over both 7-day and 30-day periods. It's been flying. However, our analysis of its recent returns shows it's statistically overstretched. It's gone up a lot very quickly.
Ripe for a pullback, maybe?
Ripe for a mean reversion move, yeah. Especially given the shifting fundamental landscape for the JPY. Sentiment here is complex, very complex. Institutional sentiment from COT shows net long EUR neutral JPY. That's historically supported the pair's rise. However, retail sentiment provides a powerful warning. An overwhelming 94% of retail traders are short EUR JPY.
94% short. That's incredible.
It's extreme. And while this is often a contrarian bullish signal, such an extreme reading can also signify a market top, where the last of the sellers have been squeezed out just before a reversal. The risk is, if the pair starts to fall, there are very few retail shorts left to cover and fuel a bounce. Instead, you could get a cascade of profit-taking from the longs, accelerating a decline. AI-driven probabilistic models. They show a mixed but slightly bearish outlook for the next 24 hours, a higher than normal probability of a sharp downside move. Reflects this conflict. Order flow interpretation is tricky. The trend has been driven by institutional buying, yes, but that extreme retail short positioning suggests a very crowded trade. A break below key support could trigger a rapid unwinding of long positions, what they call a long squeeze.
That extreme retail short position, 94%, that's almost unbelievable. Does that make this pair particularly vulnerable to a sudden sharp move if it starts to turn?
It absolutely does, yeah. When nearly everyone is packed onto one side of a trade like that, any shift in momentum can lead to a violent unwinding. It's why this pair, despite its strong long-term trend, comes with a significant caution flag for the immediate future. It's one to watch very carefully.
Okay, noted. Finally, let's analyze NZD-USD, the Kiwi expert. This one caught our eye because of that fascinating shift in institutional positioning you mentioned earlier. What's the technical and fundamental story here?
Right, the Kiwi. Technically, NZD-USD is showing signs of a nascent bullish trend. It's established a solid base of support and is now challenging key resistance levels. Price is trading above its 50, 100, and 200-day moving averages, and they're all beginning to curl upwards. That signals a potential shift to a longer-term bullish structure.
So the structure is improving.
Definitely improving. The RSI indicates bullish momentum, but importantly, it's not yet overbought. Suggests room for the upward move to continue. The MACD is providing a buy signal, confirming building bullish momentum. Price is in the upper half of the Bollinger Bands. The 20-period simple moving average provides dynamic support, and the bands are starting to widen. That indicates increased volatility, maybe for a breakout.
Setting up for a move.
Potentially. The pair is consolidating near recent highs. Key resistance is that 0.6080 to 0.6100 zone. A decisive break above there would confirm the bullish trend. Support is found around 0.6069, then down at 0.6040. The fundamental outlook for NZD-USD is constructive, primarily driven, again, by broad USD weakness. As a high beta commodity-linked currency, the NZD tends to perform well in risk-on environments.
Like GBP-USD.
Similar dynamics, yeah. The key catalyst in the next 24 hours is that China NBS manufacturing PMI. Given New Zealand's strong trade links with China, a better-than-expected PMI reading, even if it's still technically in contraction, would be a significant tailwind for the NZD. The interest rate differential is probably less of a driver here than overall risk sentiment, and that crucial China data nexus. In terms of short-term momentum, the pair has shown strong positive performance over the past 7 and 30 days. It broke out of a previous consolidation range.
New momentum.
Indicates a shift into a new momentum phase, yeah. Our analysis confirms the recent upward move is statistically significant, represents a potential new trend forming. But the most compelling aspect of the NZD-USD analysis, it really is the sentiment picture. The key signal is that institutional positioning from the COT report. Large speculators flipping from net short to net long for the first time in 11 months.
That's the big one.
That's the big one. It's a major vote of confidence from the smart money, suggests a structural shift in their view of the pair. And this institutional bullishness is set against a mixed retail sentiment backdrop. Not yet a strong contrarian signal, but it indicates the trade isn't yet crowded on the long side among retail. AI-driven simulations show a strong bullish probability for NZD-USD over the next 24 hours, greater than 60% chance of a higher close, especially if that China PMI data avoids a significant negative surprise.
Contingent on the China data, then.
To some extent, yes. The order flow analysis is dominated by that COT signal. The flip to net long represents a significant inflow of institutional capital, suggests large players are actively building long positions.
Expert, having peeled back all these layers for each pair, all this analysis, what's the one overarching signal or theme that really stands out to you from this entire deep dive?
You know, what's really fascinating is how the overarching market theme continues to be this narrative of US dollar weakness, primarily driven by policy divergence. And it's compelling to see how institutional smart money seems to be aligning so strongly with this view, even as retail traders often take the opposite side.
Creating those contrarian signals.
Exactly, creating those powerful contrarian signals for us to watch. All this multi-layered analysis, it really converges to a concise, actionable dashboard, giving you clear insights.
Exactly. So let's look at that conclusive summary table, distilled for you, the listener. For EUR USD, retail sentiment is just 11%. Long, 89% short. The projected trend for the next 24 hours, bullish. Potential price zone, 1.1680 to 1.1785. Our confidence score is a 9 out of 10. Exceptionally high convergence across all layers, particularly that powerful sentiment divergence. Slightly tempered only by short-term technicals, showing it's getting a bit overbought. For GBP USD, retail sentiment, 17% long, 83% short. Projected trend is bullish. Potential price zone, 1.3685 to 1.3770. Confidence score is an 8 out of 10. Strong technical and sentiment alignment here. Slightly less extreme retail positioning compared to the euro, hence the 8. For USD JPY, retail sentiment, 59%, long 41% short, so more mixed. Projected trend is bearish. Potential price zone, 142.50 to 144.15. Confidence score is an 8 out of 10. Based on that clear fundamental divergence and deteriorating technicals. Tempered slightly, though, by institutional COT not yet being heavily short. Suggests they're waiting for that decisive break we talked about. Now, EUR-JPY. Retail sentiment, that's striking 6% long, 94% short.
Projected trend is bullish, but with significant caution. Potential price zone, 168.7 to 170.00. Confidence score, a 5 out of 10. This is the most complex pair right now. Due to that significant divergence between its long-term trend and its short-term overbought status, plus the fundamental risk from the BOJ, and that extremely extreme retail sentiment. Lots of conflicting signals. And finally, for NZD-USD, retail sentiment, 44% long, 56% short, pretty balanced. Projected trend is bullish. Potential price zone, 0.604 to 0.6120. Confidence score is 7 out of 10. This is solid. Based on that powerful institutional positioning signal, the big flip from smart money, tempered a bit by its nascent technical trend, still developing, and the binary event risk from the China PMI data. This deep dive, it really highlights the value of looking at things from multiple angles, doesn't it? Multi-layered analysis and navigating these complex, dynamic markets. It's about looking at all the pieces of the puzzle, seeing how they connect. So what does this all mean for you? Here's a final thought. When institutional smart money makes a bold move, like flipping their position on the NZD-USD after nearly a year.
How does that change your perspective on spotting new trends? And maybe what hidden contrarian signals might you look for in your own observations going forward? Something to think about.